Hi, so today we're gonna discuss about the IAS 37 Provision Contingent Liability and Asset. My name is Renita Johan.
And my name is Yunita Ratih Nabila.
So I'm gonna introduce about the IAS 37. The last update was in 1st July 1999, and the objective of IAS 37 is to prescribe the criteria for recognition, measurement, and disclosure of provision, contingent liabilities, and contingent assets. The purpose is to ensure that appropriate recognition and measurement of liabilities are made in financial statements. So the next one is the key concept of the IAS 37. There are three: provision, contingent liabilities, and contingent assets. So provision is a liability of uncertain timing or amount, and the liability itself is a present obligation of an entity arising from past event, the settlement of which is expected to result in an outflow of economic benefits of an entity. And the contingent liabilities is a possible obligation that arise from past event whose existence will be confirmed only by future events. And the contingent assets is also a possible asset that arise from past events and whose existence will be confirmed later only by the future events. First, we're gonna focus on the provision. So provision should be recognized when the first one is an entity has a present obligation or legal or constructive as a result of a past event. And the next one, if it is probable that an outflow of research will be required to settle the obligation. And the last one is a reliable estimate that can be made of the amount of the obligation. And if all the condition is not met, then it will be a contingent liability or nothing. And if we can avoid the obligation by your future action, we should not recognize a provision, for example, a training of personnel. But if we cannot avoid the obligation, then we should recognize a provision, for example, is warranty repairs. The next one is how to measure a provision. So provision should be measured at the best estimate of the expenditure required to settle the present obligation at the end of reporting period. And this estimate of outcome and financial effect are determined by the judgment of the management of an entity supplemented by experience of similar transaction. The judgment of provision measurement is there are two most often ways of measuring provision. There are expected value and individual most likely outcome. The expected value is used when measurement of provision involves a large population of items, then it will measured as a weighted average of all possible outcomes by their probabilities. And the individual most likely outcome is used when a single obligation is being measured and then the provision will be set as the most likely outcome. The next one is the consideration when measuring provision. So there are four of several consideration when measuring the provision. There are risk and uncertainties, and then present value, future event, and no gain from disposal of assets. The risk and uncertainties, for example, is inflation, and the present value. So if you want to settle your obligation beyond 12 months after the end of the reporting, then the amount of provision should be in present value. And the future event is to include certain adjustment for future events. And no gain from disposal of assets is this gain cannot be taken into account because these gains are included in the income statement at the time specified by another IAS standard.
So next we're gonna discuss how to account for a provision, starting with the recognition process. When a provision is recognized, it's recorded as either expense or asset on the debit side, while the corresponding liability is recorded on the credit side. This ensures that the provision reflects put in the impact on financial performance and the obligation in the balance sheet. When the provision involves unwinding a discount, meaning we're accounting for time value of money, this results in a finance cost. The finance cost is debit and the liability for provision is credit. Next, the use of a provision involves reducing the liability by debiting it. While the actual cash or bank payment is credit, this reflects the obligation has been settled. Lastly, for reimbursement, if the company expects to recover part of the cost, it's recognized as a reimbursement asset on the debit side and reduce the related expense on the credit side. For example, this could happen when an insurance claim is expected to cover part of liability. Now let's move to the application of provision in three specific scenarios outlined in IAS 37. First, future operating losses. These represent expected future losses. However, IAS 37 states that future operating losses do not create a present obligation, and therefore they are not recognized as a liability. In such case, no provision is recorded. That said, company may need to assess whether there is impairment of asset if the expected losses indicate reduced asset value. Second, onerous contract. An onerous contract occurs when the unavoidable cost of fulfilling the contract exceeds the economic benefit it provides. For example, imagine a lease agreement when the rent exceeds the value derived from using the lease space. In such case, a provision is recognized, calculated as the lower of the net cost of fulfilling the contract and the penalty of for breaching the contract. Third, restructuring. Restructuring involves significant change to the manner of a business operation. For instance, relocating business activity would fall under restructuring. A provision for restructuring can only be recognized when there's detailed, formal plan that clearly outlines the action to be taken and the timeline. Additionally, the company must have created a valid expectation among stakeholders, such as employee or customer, by communicating the plan effectively. Lastly, let's look at the related interpretation under IFRIC, or the International Financial Reporting Interpretation Committee, which clarify the application of IAS 37 in specific situations. First, IFRIC 1. This interpretation deals with change in existing decommissioning, restoration, and similar liabilities. For instance, if a company operates a mining site, any increase or decrease in restoration costs due to change in the regulation will fall under IFRIC 1. Second, IFRIC 5. This focuses on right to interest arising from decommissioning, restoration, and environmental rehabilitation fund. For example, when a company contributes to a fund for decommissioning oil rigs, IFRIC 5 governs how these contributions are recognized. Third, IFRIC 6. This interpretation addresses liabilities arising from participating in specific market, like waste electrical and electronic equipment. For instance, companies selling electronic goods may incur costs for recycling or waste disposal, which IFRIC 6 helps to standardize. That's all for our presentation on IAS 37 about provision, contingent liabilities, and contingent asset. We hope the insights shared today helped you better understand the principles and application of this standard. Thank you for your time and attention.